day everyone, my name is Renzo John Lacerna and I'm here to discuss the finance function capital structure. In this lesson, we will about to understand the finance function, understand the role of CFO, and learn what is capital structure. Now let us define finance function. Finance function involves the acquiring and utilization of funds necessary for efficient operations. Finance is the lifeblood of business. Without it, things wouldn't run smoothly. It is the source to run any organization. It provides the money, it acquires the money. Finance is integral to firms' international strategies. Now let me ask you a question. Who in the company is responsible for acquiring and managing capital? To answer that question, I want to introduce to you all my friend Sir Lem Ipas. Sir Lem Ipas is responsible for managing the financial actions of the company. His duties include tracking cash flow and financial planning, as well as analyzing the company's financial strengths and weaknesses and proposing corrective actions. And most importantly, he is primarily responsible for the planning, implementation, managing, and running of all the finance activities of a company, including business planning, budgeting, forecasting, and negotiations. So what is the position of Mr. Sir Lem Ipas in a company? Yes, you're right. Sir Lem Ipas is your Chief Financial Officer. All those duties that I have mentioned in the finance function is that it is worked not only by Sir Lem Ipas. He worked with his company. So I want to discuss to you how the office of the Chief Financial Officer works. So here are the corporate finance jobs that report directly to the CFO. The FP and A manager heads the management accounting department. The controller heads the financial department. The treasurer heads the treasury department. So those functions primarily direct to the CFO or the Chief Financial Officer. They are individuals who help the Chief Financial Officer to do his job. So they are like a team. So the overall activities related to cash flows are make financing decisions, make investment decisions, and manage short-term capital needs. To discuss further about the role of CFO and the office of the Chief Financial Officer in a company, let us watch this short video.
It doesn't matter if you're running a startup or a family business or a multinational corporation. Everyone needs a CFO, Chief Financial Officer. So, what does a CFO do? 1. Works closely with the CEO in devising business strategies. 2. Implements systems and processes to gain efficiencies. 3. Ensures regulatory compliances. 4. Drives commercial negotiations, be it with clients, vendors, or investors. 5. Leads the budgeting and cash flow planning exercise. 6. Presents financial reports along with analysis to support decision-making. 7. Leads fundraising and M&A activities, and many more. Depending on the size and the stage of the business, you could evaluate whether to hire a full-time CFO or a virtual CFO, but you should certainly have one. And remember, don't compromise on the CFO role. Go for the best. Go for Super CFO.
So that is it for the office of the Chief Financial Officer. Now let's move on to our next topic. One of the most important functions of the CFO is to determine the company's proper mix between long-term debt and equity. In other words, its capital structure. So what is capital structure? A company's capital structure refers to how it finances its operations and growth with different sources of funds, such as bond issues, long-term notes payable, common stock, preferred stock, or retained earnings. And according to Investopedia, the capital structure is the particular combination of debt and equity used by a company to finance its overall operations and growth. So there are two types of capital structure, namely equity capital and debt capital. Now let's talk about equity capital. This is defined as the money put up by the shareholders or owners of the company. Equity capital itself usually consists of two sources. One is contributed capital, or the money invested in the business by the purchase of shares of stock. The other is ownership and retained earnings, or the profits from previous years kept by company and used to strengthen its balance sheet or to fund growth, expansion, and acquisition. Equity capital, however, is seen by many as the most expensive means to use because of the cost of the size of the return the company must earn to attract investors. And now let's talk about debt capital. Debt capital sa company's capital structure refers to borrowed money at work in their business. Debt is considered the cheaper of the two forms of financing capital because the interest payments on the debt as a tax-deductible expense. Long-term bonds are generally considered the safest kind of debt capital because the company has years or even decades to come up with the principal while paying only interest until the bond's maturity. Other sources of debt capital can include short-term commercial paper. Now let's move on to financial leverage. Capital structure is sometimes referred to as financial leverage, as each business has to consider the optimal ratio for running its business between debt and equity. Corporate executives have to keep capital structure in mind to either maximize shareholders' wealth or increase the company's value. Financial leverage is when purchasing assets. Three options are available to the company for financing, using equity, debt, and leases. Apart from equity, the rest of the options incur fixed costs that are lower than the income that the company expects to earn from the asset. In this case, we assume that the company uses debt to finance asset acquisition. Leveraging is the degree to which companies use leverage instead of equity capital, known as stocks or shares. Leveraging is often perceived as the most cost-effective route to capitalization because interest that companies pay on debt is a tax-deductible expense in most countries, whereas the dividends paid to investors are not. So there are times when leveraging is not the best option. One is excessive reliance on long-term debt raises financial risk and thus requires a higher return for investors. Second is foreign subsidiaries of an MNE or multinational enterprise may have limited access to local capital markets, making it difficult for the MNE to rely on debt to fund asset acquisition. So let's discuss the factors affecting the choice of capital structure. First is debt exchange rates. As with the ASEAN financial crisis of 1997, the global crisis of 2007-2019 highlighted foreign exchange risk. Leading up to the crisis, many individuals, banks, and companies borrowed in dollars or euros because of the relatively lower interest rates in the US and Europe. Second is regulatory risk. Regulatory reform has complicated access to the debt financing. Bonds are a great way of companies to raise capital for operations. However, companies also rely heavily on bank financing, and the failure of banks during the global financial crisis and resulting impact on the global company has made countries very nervous about the financial stability of the banks. So that is it for my report about the finance function capital structure. Thank you and God bless us all.